Tēnā koutou katoa. The Reserve Bank is cutting the OCR by 25 basis points to 2.25%. With a cautious household sector increasing savings and only moderate increases in consumer spending, inflationary pressures are low. The export sector has weakened due to lower commodity prices, despite volumes remaining fairly constant. There has not been a strong recovery in the business sector, and the impact of the Canterbury rebuild may come into force in the next 3 quarters, but this will not be enough to offset the general downturn of the economy. Due to low inflationary pressures and weaker export and business sectors, there is a negative output gap, which has led to our decision of decreasing the OCR by 25 basis points. The Reserve Bank is charged with keeping inflation within the target band. Where we see a persistent negative output gap, we need to act. We see the output gap has widened as the Reserve Bank has waited for firmer data and the euro crisis to play out. The time has come, given the inherent lags in monetary policy, to take some action before the gap widens even further. Our prediction is for the CPI to dip below 1% next year, if not before. As you can see, this is our prediction in the orange, and this is updated data in the red. We see that Christchurch rebuild is an upside risk later next year, although the rate of rebuild remains uncertain. The outlook for the tradable sector and outside Canterbury is to generally remain subdued, and it's here that stimulus is needed, as we are not as optimistic as Treasury in its forecasts. Many economists and banks have publicly stated their expectation for the Reserve Bank to hold the OCR, so we are now signalling our intentions that stimulus may well be needed over next year. Although 0.25% is not going to restart the economy, it will set interest rates in the direction they're needing to take to stimulate investment plans, which may currently be on hold, and maybe release some household income through lower floating mortgage repayments. This clear signal could in itself see some carry trade funds flow offshore, taking pressure off the New Zealand dollar and providing exporters relief from falling commodity prices. I will now briefly consider each sector of the economy. Retail spending and consumer confidence have shown modest improvements overall, while spending in categories such as fuel have risen. This reflects higher prices too. An increase in retail spending of 1.2% in May is encouraging, but with continued emphasis on debt repayments and savings continue to rise, our projection is only for a modest increase in the next 2 quarters. The housing market is sending conflicting signals, and there are significant shortages in some areas pushing up prices. We see this as more of a market correction than a new housing boom, as there is little evidence in longer-term growth and demand. The Christchurch housing market, of course, remains the exception, but consumer confidence, business confidence, property expectations and investment intentions remain subdued in the region. Business confidence is still slightly positive, but not enough to generate the investment to kickstart the economy. The National Bank Business Outlook puts business confidence rising 2 points from March to April, but down in May. Although building consents appear to have increased, it appears that manufacturing is contracting, according to the BNZ. The total investment intentions do not reflect the positive business confidence, nor do the capacity utilisation expectations. With lower commodity prices, farmers do not appear to be increasing livestock numbers. Machinery imports are a leading indicator, and the rise in imports trending upwards in the last 2 quarters may be a sign of recovery, but this would need to be sustained. Investment intentions do not support this. We've considered the agricultural sector as part of our analysis of the tradable sector and looked at the economic outlook of each of our major trading partners and made predictions as to commodity prices and market conditions. While some of our competitors have had some issues with stock diseases and drought, the impact of these may or may not be significant. While there are some technical reasons for some of the downturn in dairy prices, on the production side, gains in efficiency look to be offset by less favourable weather, making increases in production minimal. Investment intentions confirm lowering stock numbers. Land prices have continued to decline, and while overseas supply scares may boost demand, overall the outlook is at best fair. With beef exports, overseas factors may have a positive impact in the short term, and we're predicting some modest gains here. Looking at our major export destinations, there are some concerns. With 4.3% in growth, Australia is still in a strong economic position, although mining is looking to plateau in 2 years and the carbon tax may decrease production and raise the cost of living. China is still growing at an enviable rate, but as you can see, the rate is dropping. And this is reflected in declines in new export business and orders. Against these gloomy figures, it is fair to say that China hardly needs the rest of the world, with cheap finance, booming investment, and a housing market buoyant. In the US, while growth was predicted to be 3%, it has fallen well short, and unemployment remains constant. The drought affecting the Midwest has reduced output of corn by 25% and increased prices. The flow-on effects of this could boost our beef exports through the cost and availability of corn feed for US beef. The euro crisis is not showing any signs of passing, with unemployment rates still rising, especially in Spain and Greece. With 2.8 billion euros worth of exports at risk and the flow-on effects to the US and China, Europe remains a major concern. Overseas earnings are likely to show little growth, with lowering real prices of several key export products, such as lamb, milk and wool. While the price of beef remains high, the quantity produced in New Zealand is unlikely to increase due to lowering investment intentions. Commodity imports are predicted to rise, with oil prices unlikely to fall, and the rebuild in Christchurch creating a rise in associated imports. On balance, we see our exchange rate holding even with current interest rates, still higher than the US and Australia, meaning inflows of funds offsetting any tendency for the trade balance to put downward pressure on the New Zealand dollar. The May budget carries no significant fiscal stimulus over the next year, and a return to surplus is likely by at least 2015. The current account deficit increase is related to Canterbury. While fiscal responsibility is desirable for medium and long-term growth, in the short term it may be the role of monetary policy to provide stimulus for the rest of New Zealand. Turning now to some supply considerations. The unemployment rate for the first quarter 2012 was 6.7%. This was forecasted to decrease to 6.5% in the second quarter. This remains to be seen. The labour cost index increased by 2.1% in the year to March 2012, which demonstrates that labour costs have increased more than productivity, with weekly earnings up 3.4%. Overall, businesses had to absorb this. Energy costs have a significant impact on business competitiveness. The effect of the events in Syria and Libya may spread to other Middle Eastern countries, causing a future rise in oil prices, adding to New Zealand's firms' costs. Wholesale electricity spot prices have been extremely high due to lower than average lake levels and winter supply uncertainties. This adds future costs and uncertainties for business. I would now like to step through our conclusions from the preceding analysis. In June 2010, there was a positive output gap, which led to the Reserve Bank raising the OCR. By mid-June 2011, it was becoming clear to us that the New Zealand economy was not recovering as quickly as expected. Fragile was the expression used. The OCR was kept on hold, despite many expecting a rise sooner or later. By June 2012, we see the output gap has widened, and without some stimulus could well continue to widen. This would push the CPI well below the target range, and while this is not in itself a short-term concern, without corrective action and time for that to work, it could well dip even lower, which is a real concern, as deflation has serious consequences. With today's cut, and possibly more aggressive cuts in the near future, the economy can track back to achieving our potential GDP target by mid-2013, when again our attention will turn to the upside risks to inflation generated by the Canterbury rebuild. Kia ora mai.
The crowd can give support. Okay, so thanks for the presentation. Now we'll move on to questions and answers. It's just like the regional finals, where we'll ask you a question. What we'd like you to do is, if you could discuss it amongst yourselves loud enough so that we can hear your line of thinking. Then if someone can summarise and bring that back would be good. The difference here is we've got 20 minutes today rather than 10. Okay, so first question. What are the consequences if the government doesn't meet its return to surplus by 2014-2015 as it is projecting to do so?
If the government doesn't return to surplus, then that'll mean that they're still spending more money than they're earning, so there'll be more money flowing into the economy.
Yeah, so you can discuss that.
Okay, so it'll be...
Which
it's not good for business confidence.
Yeah, if the government's not meeting its targets, it's not very reassuring.
No, so possibly, lower business confidence. Also, it's not very to overseas.
The deficit we keep having a deficit that will keep rolling over, and that may or may not roll over. It depends. We'd have to extend our loans.
Yeah, debt may not. Yeah, so if they don't want to roll over a debt,
There could have consequences, but
increase.
but it's mainly
So
and of course the extra money in the economy would mean there'd be demand pull inflation pressures from the money that they're not taking out from the economy to meet that surplus.
So it's going to increase demand pull.
There'll be inflationary pressure, I'd say.
yeah. Is that all?
Yep. So in summary, that'd have a negative effect on confidence in the New Zealand economy, that they're not able to meet their targets, and the additional money that's coming into the economy due to their deficit would also lead to inflationary pressures.
Okay, it was great to see that you had forecasts for quite a few variables in your presentation. What do you see happening to the unemployment rate in New Zealand over the medium term?
So unemployment rate, as we know, we predicted it to decrease, and it did increase to 6.8%. But, it depends.
Over the medium term, once the Canterbury rebuild gets underway, that'll certainly
that will definitely
will reduce unemployment.
Looking at a growth figure at the moment. So I think, the Canterbury rebuild, and is there any areas where it would decrease? Employment? I don't see any.
Not
Apart from businesses moving, shifting overseas.
Yeah.
But
It's fairly standard.
I don't think there's going to be a big
unless there's a major event.
and the increase in.
Yep.
Okay, so we see that the Canterbury rebuild, that will create, over the medium term, that will create a big decrease in the unemployment rate, and we don't see any factors in the medium term that will increase unemployment. So.
Okay, thank you.
So why does the Reserve Bank target inflation rather than, say, growth or exports? And would you think it wise or foolish to change the Reserve Bank's mandate to target only inflation?
So to target all inflation? Only inflation.
The one advantage, I guess, of only targeting inflation is that
It's easy.
because they don't have to have conflicting aims they're trying to achieve, they can, with pretty much
That's true.
total focus, ensure that the inflation stays within that range,
Because otherwise,
provides more confidence in what they're going to do.
Yeah.
By targeting inflation, it's sort of indirectly sort of having effects on
Yeah,
other
it can have
areas as
effects,
well.
but it's not their main.
Yeah.
And the idea is also, if it's only targeting inflation, that could have a more stable economic situation, which could then lead to more growth, indirectly affecting.
It does
while
affect
they
them
might not-
indirectly.
While they might not be directly targeting growth, managed
Because-
inflation
yeah,
certainly is conducive to
because
growth by providing
high
confidence.
inflation, it creates uneven growth, and so the Reserve Bank targets inflation because the targeting inflation will have the indirect effects to growth. Growth because high inflation creates uneven growth, and
Okay. So would you keep the current mandate, or would you want to change it?
I mean, certainly you could consider changing it, but I don't think currently there's any dire situations that would need to.
Export prices,
I mean,
the exchange rate, would you need to consider that?
you mean like making exceptions and stuff?
No, like changing the interest rate, OCR.
Oh, so because they were considering doing it
exchange rates.
for the high exchange rate,
Yeah, because
or something like that.
does that count, like changing the OCR so that it affects exchange rates?
Yeah. Should we do that or not do that?
It might not be fully effective, so
Yeah.
there might it might not be as effective as it is on inflation. So, and there might be.
It could have effects on other things that they don't want to.
Yeah, exactly. Like if they because if they
If they lower it or raise it, could affect the other things. I don't know. Yeah.
So I think that it could be used for other things like for the exchange rate when an exchange rate was really high, but then again there would be flow-on effects. It would affect the interest rates and the investment, and I think that it's best to just be kept to be used for inflation targeting.
Very good. The actual target is between 1 and 3%. Why 1 and 3?
as opposed to just low, or yeah.
Well, it needs a bottom because we don't want deflation because that has serious consequences.
But the consequences of deflation being that if money's gaining value in real terms, then there's no incentive to spend in the moment, which would contract the economy in real terms.
As a margin, you can go slightly above 3%.
Yeah, and 1 and 3% on average. Yeah. So that's
And high inflation would lead to the problem with high inflation is that it'd mask price signals, because if all prices are increasing, then it's hard to tell where actually the prices are increasing and decreasing in real terms, which might lead to businesses not allocating their resources in the best way. And also that if inflation's high, it's hard to. There's uncertainty from what it's going to do, which also, and I'd say the reason it's between 1 and 3% as opposed to just zero is that I think
deflation.
The thinking is that the consumers do benefit from a slight push to spend now, so because if their money
stimulate.
So in conclusion, both high levels of inflation or deflation are bad for the reasons we've said, but economically there does seem to be evidence that a slight push to spend now would benefit the economy.
Okay, very good. Of course, it's the Reserve Bank who gets to decide on interest rates, and not the Prime Minister or the Minister of Finance. Why is that the case?
The Reserve Bank is independent.
Yeah, like was discussed before, if we are going to have the Reserve Bank's intention to be focusing solely on inflation, the Prime Minister and other government organisations would certainly have other goals they're trying to meet. Such growth, employment.
Because inflation's good for the government. Because of
the government could also benefit from inflation. Not that they do this, of course, but from people's wages increasing, that would push them into higher tax brackets and stuff. So by keeping it separate, I guess there's that confidence that the Reserve Bank will definitely be acting to match inflation targets.
Thank you.
Okay, should the Reserve Bank intervene in the currency market currently to reduce the value of the New Zealand dollar?
I think we were just covering it before.
The New Zealand dollar is definitely at one of its, especially at a high point at the moment.
It isn't as high as it was, but it's still high.
It's still high, and that does affect exports.
Exports. So, but like we were saying before, they could lower the OCR, and that could decrease the exchange rate,
It's carry funds.
But like I think we need to look at, when we look at the OCR, we need to look at whether there's a positive or negative output gap, not.
I think the only
I'm not talking about reducing the OCR to influence the currency, but rather directly going into the currency market and buying or selling New Zealand dollars.
Sorry. Okay.
Well, the primary objective of them doing that, if they were to, would be to maintain financial stability and ensure that businesses can have a reasonably confident outlook of what's going to happen in future.
Mm-hmm. I mean, they do buy foreign bonds.
They do have foreign reserves.
Well, yeah, they do buy foreign reserves, don't they? So, would there be much? So in conclusion, the Reserve Bank does buy foreign reserves. So
What was the original question?
Should the Reserve Bank intervene in the currency market to lower the value of the
Certainly to maintain
price stability.
stability in the exchange note with no shocks or anything that could upset business to any large degree.
Be a bit more, be more stable and better for exporters and importers.
Okay, so there's been competition between banks recently, which has meant that retail mortgage interest rates have been lower. Given your decision to cut interest rates, is this concerning?
Competition.
Them lowering their
So then,
interest rates.
yeah, the floating mortgage repayments. I mean,
Well, the effect of cutting and floating, well, because it'll be floating ones that'll be immediately affected. The effect of cutting those rates would be that consumers now have less money to spend on financing their mortgages, which does mean they have more money to spend, which would be
which they could
which would
possibly
be
spend on retail.
inflationary pressure. And so I guess it'd come down to looking at if that effect is enough to offset the other downwards pressures, and we'd have to make that assessment of where we stand in regard to the output gap.
But considering that we're in a period of fairly low inflation at the moment, inflationary pressures aren't necessarily much of an issue right now. But they could become so in the future.
And given the lag and the effects of OCR cuts, you'd certainly have to be mindful of not leaving it too late to act and anticipating what's going to happen in the future.
Yeah.
So would that get you to rethink your decision at all, or does it change your decision in any way?
There's only so low they can go. There is the kind of
Yeah.
benchmark interest rate, so they can only drop so far. It's sort of semi-controlled.
I don't think it would change our decision because we looked at the fact that there was a negative output gap.
I mean, it is just, consumer spending is just one sector of GDP.
Just one sector
so,
that we need to think about.
and it certainly would counter to some extent what we were expecting, but we'd have to probably see exactly how large that effect is going to be before we change any decisions.
So your recommendation was to cut the official cash rate. What would have to happen to your forecasts to change that decision to keep it on hold?
I think we'd want to see more of a recovery now in the economy.
Like business.
Yeah, business
confidence.
confidence. Capacity utilisation.
Consume. Because
Signs
really
of the
modest.
Canterbury Rebels or something.
Yes, the Canterbury Rebel.
We'd be looking for more positive leading indicators, so that we can be sure that the current downwards trend of the inflation isn't going to go out of that band but will recover.
Because we did look at the machinery imports, which were increasing, but we said that they had to be sustained to sort of show the recovery.
So certainly with a sustained sort of trend of recovery, then if that did occur, then hold it.
So we'd have to see recoveries in business and in machinery imports and just leading indicators and consumer confidence. So investment intentions. All of those indicators.
Okay, do you think the current interest rates are stimulatory? 2.25%. Do you think that is a stimulatory interest rate?
I think,
It's certainly historically low, so
Yes, it is.
but We think it's showing that it's not low enough.
Or the fact that it hasn't, that investment intentions are still fairly low, and it is so low, suggests that it's not
quite working.
The cut was more of just to show where we think it should be going rather than a natural.
The 0.25% was just also because we don't, because many banks were expecting to hold the OCR. The 0.25% was just to show that we think that interest rates need to take this direction to stimulate. So
it was I mean our cut was more of a signal of intent rather than any dramatic.
Especially because of the lags, so either keeping it the same or lowering it further in the future. So.
Sorry, what was the question?
We thought they weren't stimulatory enough, and that they could be lowered a bit more, and in the hope that the economy would stimulate due to those low interest rates.
So what would you do as the Reserve Bank if house price inflation in Auckland started taking off?
Well,
we would.
Like we said, we thought that was more of a market correction.
But if it does.
If it does take off, well.
If it take off, we'd have to raise them back up.
If it had large enough effect.
It depends how big it was.
Also, that's just one. I don't know. Auckland is a big.
Auckland is although it's the centre, or it's a large part of the country, it's showing a different trend to the whole rest of the country.
Yeah.
It would put us in a challenging position if house prices were going up, but there still wasn't that pressure on the other sectors of the economy.
Yes.
So I mean, we'd have to weigh up overall how that's going to affect the sort of basket we're going for. And if house prices are unique in their trend.
Increases in house prices do tend to push inflationary pressure, buying new whiteware and things like that as they go. And
I mean, and if they were contrary to what was happening with the rest, we might have to advise the government in some regard, and that they might have to manage it through other means as well, if it's countering what's actually happening with inflation overall.
Time? Excellent. So let's think internationally. We're seeing lots of news coming out of Europe, and it's all bad news. What would you do? What would you advise the Greek government to do at this point?
Well, I mean, it depends where they are on their, PPC. If they, if they just, because one thing, if they just spent, that could, it depends
Is
where
this
they are.
specifically a OCR and Reserve Bank question, or just
Economically?
in general?
It's an open question.
Yeah.
Open question.
If you got the opportunity, what would you tell them to do?
Well, like I said, it depends where they are.
Long term, it's crucial that they restore that loss of confidence, because once you've lost confidence in a government to repay its debt, then they're going to find it extremely hard to gain financing, which isn't an ideal situation to be in.
But if they're not able to raise the funds, and they're not willing to, they're not able to pay them back, and they're not accepting, would they get pulled out of the Eurozone and pardon?
Because certainly
and stuff. That would, whether that would be how negative the impacts of that how bad that is, would be interesting to see. Because if they were to just drop everything.
I mean, certainly the Greek economy hasn't been perhaps as strong as some of the other European countries, which I guess you could say to some extent that they have been free riding slightly on the success of the other nations in the currency. And so, I mean, to be a long-term partner that sort of the Eurozone would want to keep, then they'd sort of have to be looking at how they can better collaborate and perhaps specialise to fit into the European economy better.
Thank you. I think we're done at this point. You can now relax. It's all over. Thank you very much.